September 16, 2008. Lehman Brothers Headquarters, New York. 6:23 a.m. The lobby was silent. Not the usual morning silence of a building waiting to wake, but the heavy, suffocating silence of a tomb. The marble floors that had echoed with the footsteps of bankers and traders for 158 years reflected nothing now but the pale dawn light filtering through the glass facade. Outside, a television crew was setting up cameras. Inside, a security guard sat at the reception desk, staring at a computer screen that displayed a single line of text: "System offline." By noon, 30,000 employees would learn they no longer had jobs. By week's end, the global financial system would teeter on the edge of collapse. But at 6:23 a.m., in the empty lobby of what had once been the fourth largest investment bank in America, the only sound was the hum of the air conditioning. A system still running, oblivious to the fact that the institution it served had ceased to exist. The guard, a man named Martinez who had worked this desk for 12 years, reached for his coffee. His hand was shaking. Not from fear exactly. From the realization that the game had rules he had never been told, and that the people who knew those rules had already left the building. They had believed the system was solid. By morning they learned it was smoke. The collapse of Lehman Brothers was not an anomaly. It was a revelation, a moment when the mechanisms of wealth, usually hidden behind layers of complexity and jargon, became suddenly, terrifyingly visible. The rich do not play the same game as everyone else. They play with different rules, different tools, different stakes. And when the game collapses, they rarely pay the price. This is not a story about greed, though greed is present. It is not a story about corruption, though corruption plays its part. This is a story about structure, about how wealth is not earned but engineered, not accumulated but leveraged, not protected by virtue but by access to systems that most people do not even know exist. The game of wealth is not won by working harder or saving more. It is won by understanding that money at its highest levels is not a thing but a relationship, a web of contracts, institutions, and assumptions that can be manipulated by those who know where the levers are. Robert Chin had understood this from the beginning. He had grown up in a middle-class suburb of San Francisco, the son of immigrants who had worked 60-hour weeks to send him to Stanford. He had graduated with a degree in economics, taken a job at a mid-tier investment bank, and spent his 20s learning the language of finance: derivatives, tranches, collateralized debt obligations, credit default swaps. Words that meant nothing to most people but everything to the small circle of professionals who used them to reshape reality. By 2005, Chin was a vice president at a hedge fund managing $3 billion in assets. He was 32 years old. He earned $800,000 a year, plus bonuses that could double or triple that figure depending on performance. He owned a condo in Manhattan, a beach house in the Hamptons, and a portfolio of stocks that grew with a consistency that felt less like luck and more like inevitability. He was not rich by the standards of his industry, but he was comfortable. More importantly, he was inside the system. He attended the same conferences, dined at the same restaurants, traded favors with the same network of lawyers, accountants, and brokers who formed the connective tissue of modern finance. He knew how the game worked, and he played it well. In the summer of 2006, Chin began noticing cracks. Small things at first. A fund that specialized in subprime mortgages reported unexpectedly high default rates. A colleague mentioned that housing prices in Nevada were softening. An analyst circulated a memo suggesting that certain mortgage-backed securities were overvalued, that the models used to price them were flawed, that the entire housing market might be built on assumptions that would not survive a downturn. Chin read the memo. He understood what it implied. But he also understood that predicting a crash, being right too early, was as dangerous as being wrong. Markets could remain irrational longer than you could remain solvent. So he hedged. He took out insurance on the mortgage bonds his fund owned, bought credit default swaps that would pay out if the bonds failed, and waited. He did not warn anyone. Warning was not part of the game. CTA, if this moment already changed how you see money, subscribe, the next will expose even more. The rich play the game differently because they have access to instruments that do not exist for ordinary people. Leverage is the first. Leverage allows you to control assets worth far more than the cash you actually possess. If you have $100,000 and you borrow $900,000, you can buy a $1 million asset. If that asset increases in value by 10%, you have not made $10,000, you have made $100,000, doubling your initial investment. Of course, if the asset decreases in value by 10%, you lose everything. But that is a risk the wealthy are willing to take because they know something the middle class does not. Losses can be contained, deferred, or transferred. Chin's hedge fund operated with a leverage ratio of 10 to 1. For every dollar of actual capital, the fund controlled $10 of assets. This was not unusual. Some funds operated at 20 to 1. Investment banks operated at 30 to 1. Lehman Brothers, in its final years, operated at leverage ratios exceeding 40 to 1, meaning that a 2.5% decline in asset values would wipe out the entire firm. But the assumption, the foundational belief that justified this risk, was that markets were efficient, that prices reflected reality, and that catastrophic declines were statistically impossible. The model said so. The regulators accepted it. And the people making billions of dollars had no incentive to question it, until the cracks became fissures. The first major failure came in June 2007, when two hedge funds managed by Bear Stearns collapsed after their investments in subprime mortgage securities lost nearly all their value. The funds had been leveraged 20 to 1. When the mortgages defaulted, the funds could not cover their losses. Bear Stearns tried to contain the damage, but the contagion spread. Other funds holding similar securities saw their values plummet. Banks that had lent money to these funds began demanding repayment. The web of interconnected obligations, each institution owing money to others, each assuming the others were solvent, began to unravel. Chen watched from his office as the crisis unfolded. His fund's credit default swaps were paying out. He was making money while the system burned. It felt less like victory and more like witnessing a car crash in slow motion, horrifying, inevitable, and impossible to stop. By September 2007, the Federal Reserve had begun cutting interest rates to stabilize the system. By March 2008, Bear Stearns itself had collapsed and been sold to J.P. Morgan Chase for $2 per share, a fraction of its former value. By summer, housing prices were in free fall. Foreclosures were spiking. Unemployment was rising. And still, the narrative from regulators and financial leaders was the same. The crisis was contained, the worst was over, the system was fundamentally sound. Chen knew better. He also knew that the people repeating these reassurances knew better. But acknowledging the truth would trigger panic. So they lied. Not out of malice, but out of a desperate hope that confidence, once lost, could be willed back into existence. It could not. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history, $639 billion in assets, gone. The stock market plunged. Credit markets froze. Banks stopped lending not just to risky borrowers but to anyone because no one knew which institutions were solvent and which were teetering on the edge. The global financial system, built on the assumption of perpetual liquidity, discovered that liquidity could vanish overnight. Chen's hedge fund survived. Barely. The credit default swaps had cushioned the blow, and the fund's managers had been cautious enough, or lucky enough, to avoid catastrophic exposure. But many of Chen's colleagues were not so fortunate. Funds shut down. Banks failed. Fortunes evaporated. And the people who had built their lives on the assumption that the system was stable found themselves standing in the wreckage, holding worthless securities and wondering how it had all gone so wrong. But here is the thing, the wealthiest did not lose. They had hedged. They had diversified. They had access to private placements and offshore accounts and legal structures that shielded their assets from the carnage. When Lehman collapsed, its executives walked away with millions in deferred compensation. When banks failed, their shareholders were wiped out, but their bondholders, the institutional investors who had lent money to the banks, were often made whole through government bailouts. The system had collapsed. But the people at the top of the system had parachutes. Chen sat in his office on the evening of September 16 and stared at his computer screen. His fund was up 18% for the year. He had made $2.3 million in bonuses. Outside, the economy was disintegrating. Inside, he was fine. He thought about Martinez, the security guard at Lehman. He thought about the tellers at Washington Mutual, the largest bank failure in U.S. history, which had collapsed just days earlier. He thought about the millions of homeowners facing foreclosure, the workers losing their jobs, the retirees watching their 401(k)s evaporate. And he thought about the fundamental asymmetry of the system. Risk was socialized, profit was privatized, and the people who understood how to navigate the machinery of finance were insulated from the consequences of its failure. He had not caused the crisis. He had not sold subprime mortgages or packaged them into securities or rated them as safe when they were toxic. But he had profited from the disaster. And that profit was not luck. It was knowledge of how the system worked, of where the vulnerabilities were, of how to position himself to benefit when others suffered. This, he realized, was the game. Not morality. Not fairness. Just information, leverage, and access. The mechanics of wealth at the highest levels are invisible to most people because they operate in realms that require specialized knowledge and capital to access. Consider the carried interest loophole, a provision in the U.S. tax code that allows hedge fund managers and private equity executives to classify their income as capital gains rather than ordinary income. This means they pay a maximum tax rate of 20% instead of the 37% top marginal rate that applies to wages. The justification is that they are investing their own capital and should be rewarded for taking risk. The reality is that much of the capital is other people's money, and the managers earn fees regardless of whether their investments succeed or fail. Or consider offshore tax havens. Wealthy individuals and corporations shift profits to jurisdictions with low or zero tax rates. Bermuda, the Cayman Islands, Luxembourg, using complex legal structures that are perfectly legal but ethically dubious. The result is that multinational corporations pay effective tax rates far below what small businesses pay, and billionaires often pay lower percentages of their income in taxes than their secretaries. Or consider family offices, private wealth management firms that serve a single ultra-wealthy family. These offices employ teams of accountants, lawyers, and investment professionals whose sole job is to preserve and grow the family's wealth. They use strategies unavailable to ordinary investors: direct investments in private companies, access to pre-IPO shares, participation in exclusive real estate deals, customized tax optimization schemes. The cost of operating a family office can exceed $1 million per year, which means this level of wealth management is accessible only to those with assets in the hundreds of millions. The game is not hidden. It is simply played on a field most people cannot enter. If you're seeing the financial system in a new light, subscribe. The Aftermath will challenge you even more. The aftermath of the 2008 financial crisis revealed the rules with brutal clarity. The U.S. government intervened to prevent total collapse, injecting $700 billion through the Troubled Asset Relief Program, TARP, to stabilize banks deemed too big to fail. The Federal Reserve cut interest rates to near zero and began buying trillions of dollars in bonds to pump liquidity into the system. These measures worked in the sense that they prevented a second Great Depression. But they also reinforced the lesson that had been learned in every major financial crisis for a century: the wealthy are protected and the rest are not. Homeowners received no comparable bailout. Roughly 10 million families lost their homes to foreclosure between 2007 and 2016. Unemployment peaked at 10%. Median household wealth declined by nearly 40%. Meanwhile, the stock market, fueled by low interest rates and corporate buybacks, recovered and then soared to record highs. By 2020, the wealth of U.S. billionaires had increased by over 40% from pre-crisis levels, while median wages had barely kept pace with inflation. Chin left the hedge fund in 2010. Not because of moral qualms, though those existed. Because he had learned what he needed to learn. He understood how the system worked. He understood that wealth was not about salary or savings but about access to information, to capital, to legal structures that allowed you to extract value while minimizing risk and tax liability. He started his own firm, a family office managing the wealth of 3 ultra-high net worth clients. He hired a team of specialists. He structured investments to maximize returns and minimize taxes. He used trusts, LLCs, and offshore accounts to shield assets. He operated within the law, but he operated in spaces the law barely touched. By 2015, his clients' wealth had doubled. His own net worth had grown to $15 million. He was not a billionaire. But he was inside the system and he knew how to use it. One of Chen's clients was a tech entrepreneur named Sarah Voss. She had sold her company for $200 million in 2012 and hired Chen to manage the proceeds. Voss was 41, a former software engineer who had built a logistics platform that Amazon eventually acquired. She was smart, driven, and uncomfortable with the attention that came with wealth. "I didn't grow up with money," she told Chen during their first meeting. "I don't want to become the kind of person who hoards it." Chen nodded. He had heard this before. Wealthy people often express discomfort with their wealth, as if acknowledging the discomfort absolved them of responsibility. But discomfort did not change behavior. Voss wanted to keep her wealth. She wanted it to grow. She just wanted to feel good about it. Chen explained the strategy. They would establish a donor-advised fund, a charitable vehicle that allowed her to take an immediate tax deduction while distributing the money to charities over time. They would invest a portion of her wealth in opportunity zones, economically distressed areas where capital gains taxes were reduced or eliminated. They would use a grantor-retained annuity trust to transfer assets to her children while minimizing estate taxes. They would diversify into private equity, real estate, and venture capital. Asset classes that offered higher returns than public markets and were less correlated with economic downturns. How much of this is legal? Voss asked. All of it, Chin said. The question is not legality. The question is access. Most people cannot do these things because they lack the capital, the knowledge, or the professional network. You have all three. Voss signed the contracts. Within 5 years, her wealth had grown to $340 million. She donated $20 million to charity, received a $7 million tax deduction, and paid an effective tax rate of 11% on her income. She felt good about the charity. She did not think much about the tax rate. The structure of modern wealth is not new. It has been refined over centuries, shaped by legal precedents, tax codes, and financial innovations that favor those who already have capital. What is new is the scale. The gap between the wealthy and everyone else has widened to levels not seen since the Gilded Age. In 1980, the top 1% of Americans held roughly 10% of the nation's wealth. By 2020, they held over 32%. The bottom 50% held just 2%. This is not an accident. It is the result of policy choices. Tax cuts for the wealthy, deregulation of financial markets, the decline of labor unions, the rise of stock-based compensation for executives. Each change, taken individually, seemed reasonable. Taken together, they created a system where wealth compounds exponentially for those who have it and stagnates for those who do not. Chin saw this clearly. He also saw that explaining it changed nothing. People wanted to believe that wealth was the result of hard work, intelligence, and virtue. They wanted to believe the system was fair. Admitting that it was not, that the game was rigged in favor of those who started with capital and knowledge, was too destabilizing. So the mythology persisted: anyone can get rich if they work hard enough. And the people who knew better stayed quiet because the mythology benefited them. In 2019, Chin attended a private wealth conference in Aspen. The attendees were family office managers, private equity executives, tax attorneys, people who made their living helping the wealthy stay wealthy. The keynote speaker was a former Treasury official who had helped design TARP. His speech was titled Resilience in Uncertain Times. He talked about diversification, about the importance of maintaining liquidity, about the need to stay informed. He did not talk about the millions of people who had lost their homes. He did not talk about the fact that the recovery from 2008 had been the most unequal in modern history, with nearly all the gains going to the top 10%. He did not talk about the structural inequities that allowed the attendees in the room to preserve their wealth while everyone else struggled. After the speech, Chin approached him. Do you ever think about the people who didn't recover? The former official looked at him for a moment. Then he said, every day. But thinking about it doesn't change the system. The system is what it is. You either understand it and use it or you don't. Chin walked away. He knew the man was right. He also knew that rightness was not the same as justice. By 2023, Chin's firm managed over $2 billion in assets. He had expanded his client base to include tech executives, real estate developers, and inheritors of family fortunes. He employed 30 people. He operated out of a discreet office in Palo Alto with no signage, no public presence, no advertising. Wealth at this level did not advertise. It simply existed, compounding quietly, insulated from the volatility that affected everyone else. Chin was 50 years old. He had more money than he could spend in a lifetime. He had achieved what most people considered success. And yet, he could not shake the feeling that he was complicit in something he did not fully understand. Not the mechanics of finance, which he understood perfectly, but the moral architecture of a system that rewarded him so richly for doing so little. He thought about Martinez, the security guard at Lehman. He had tried to find him once, years ago, but had been unsuccessful. He wondered if Martinez was still working security, still showing up at dawn to guard buildings that might collapse without warning. He wondered if Martinez understood that the game had never been fair, that the rules were written by people who had no intention of losing. He suspected Martinez understood perfectly. If this story moved you, subscribe, because the systems that define wealth aren't always visible, and the rules aren't always written down. The game of wealth is not played on a level field. It is played in boardrooms and law offices and offshore jurisdictions, by people who have access to tools and strategies that are invisible to those outside the system. It is played with leverage, with tax optimization, with legal structures that separate ownership from liability. It is played with information asymmetries, where those who know more can extract value from those who know less. And it is played with patience. The wealthy do not need immediate returns. They can afford to wait, to ride out downturns, to hold assets until they appreciate. They do not live paycheck to paycheck. They do not face margin calls or foreclosure. They have safety nets woven from trust funds, family offices, and intergenerational wealth transfers. The middle class does not have these advantages. They have wages which are taxed at higher rates than capital gains. They have savings which earn minimal interest. They have homes which are often their only significant asset, and which can be seized if they fall behind on payments. They live in a different economy, governed by different rules, with different risks and far fewer protections. This is not a conspiracy. It is a structure. And structures, once established, are extraordinarily difficult to change. Chen thought about writing a book. Something that would explain how the system worked, that would demystify the mechanisms of wealth for people who had been told the game was fair. But he knew it would change nothing. The people who needed to understand already knew, deep down, that they were playing a rigged game. And the people who benefited from the rigging had no incentive to dismantle it. So he kept working. He kept managing wealth, growing it, shielding it. He kept playing the game because stepping away meant admitting that the game was unjust, and admitting that meant confronting his own complicity. In the end, he decided, everyone made the same calculation. They looked at the system, saw how it worked, and decided whether to participate or resist. Most people participated. Because resistance required sacrifice, and sacrifice required believing that something better was possible. Chen was not sure he believed that anymore. The game of wealth is not won by the most virtuous or the hardest working. It is won by those who understand the rules that are complex, opaque, and deliberately designed to favor those who already have capital. The rich play differently because they can. They have access to leverage, to legal structures, to professional networks that allow them to extract value while minimizing risk. They operate in a parallel financial system that most people never see and cannot access. And when the system fails, when bubbles burst and banks collapse, they are protected. Not by luck but by design. By bailouts and tax havens and golden parachutes. By the knowledge that losses will be distributed downward while profits flow upward. This is not capitalism in its idealized form. It is capitalism as it actually functions. A game with two sets of rules, one for those with capital and one for everyone else. Chen understood this. He also understood that understanding changed nothing. The game would continue. The wealth would compound. The gap would widen. And the people like Martinez, the security guards and tellers and homeowners who trusted the system, would keep losing, not because they played poorly but because they were never given a fair chance to play at all. The lobby of Lehman Brothers is a bank now. The marble floors still shine. The security desk is still staffed. But the institution is gone, replaced by something new, something that learned the lessons of 2008 and adapted. The game continues. It always does. Chen drives past the building sometimes on his way to meetings with clients who want to know how to preserve their wealth, how to minimize their taxes, how to ensure their children inherit without losing half to the government. He tells them what they want to hear. He structures their trusts and offshore accounts and donor-advised funds. He plays the game. And he thinks about the guard. About the silence in the lobby that morning. About the realization that the rules had always been different, and that the people who knew the rules had already escaped. They had believed the system was solid. They learned it was built for someone else.